How's it going, everyone? Welcome to another video of the course. Now this video will be specifically on seconds time frame. How do I take entries on the seconds time frame? What is the logic behind taking the seconds time frame entry, and do you need it or do you not? So before I start the video, I want to make sure that everyone is on the same page with me that you should not touch the seconds time frame until you are consistent with the 1 minute time frame entries, be it taking a swing trade, scalping, or any of that sort. You should not be looking into the seconds time frame, because if you're not consistent on the minute time frame, you are definitely not going to find consistency in the seconds. So another thing to note is that the seconds time frame is not necessary to trade. It is something that will help you once you've mastered the 1 minute time frame, and also mitigate some losses in certain scenarios. So I have to make sure that everyone understands that, because the seconds time frame isn't that last piece in the puzzle. It is just something that has helped and has proven to help numerous times. So just make sure you understand that. So let's get into the video. Right now I have two diagrams here, which is a 1 minute time frame and a seconds. And as you can see on the 1 minute time frame diagram, you can take this as a confirmation entry of maybe a higher time frame zone or even a scalp trade. You have a 1 minute mitigation here, right, in this circle. And essentially what normally people would do without the seconds is maybe take a trade off the 25% mark, or take a trade off the distal, which is the start of that zone, or the equilibrium, which is the 50% zone, 50% mark of that zone. Now these are the normal ways that trades will be taken. So what and how does the seconds time frame really come into play is when you get that first initial 1 minute mitigation of your zone. You essentially, what I do is I drop to the seconds here, as you can see here, and on the seconds time frame what you're actually looking for is the exact same thing here you have seen that is set up will and should repeat itself on the seconds time frame here. So what this is essentially is that mitigation over here. So that small little mitigation that on the 1 minute just looks like a tap and a push down, what's happening on the seconds is essentially the market repeating itself in terms of the same exact pattern or the same exact price action you've seen on the 1 minute happening on the seconds. Now this usually happens because the market is fractal. Whatever happens on any time frame will repeat itself on basically every other time frame. So because of how fractal the markets are, it is completely okay and it completely makes sense to see the exact same movement in price here if price is going to continue down the direction. So let's say you're taking a supply zone here for a short. You should see the exact same movement here. You should see a chalk. You should see the exact same entry requirements on the seconds to support why price is going to be pushing down. So how do I use the seconds time frame? Essentially I look for 1 minute mitigations on my swing trades or intraday trades, or scalps as well, and I look for the exact same confirmation. Now this is not necessary, like I said, but how does this help? First of all, what it does is it gives me additional confirmation that look, we have created another chalk on the second. So you've got the first layer of confirmation, which is on the 1 minute mitigation. You've got your second layer of confirmation that the seconds time frame is also showing a chalk and it is respecting a supply zone in that area. So that gives me an extra confidence that price is going to indeed be pushing towards the direction that I want. That's how I use the seconds. Now, if we speak in terms of a swing trading method, right, a higher time frame zone instead of scalping, you first of all have your higher time frame zone mitigation, right, and then you have your confirmation entry on the 1 minute, right. Forgive the drawing, but you guys understand what I mean. Right, we have our first initial high time frame mitigation, then we have a push down and a confirmation entry on the 1 minute. So essentially you have you have your higher time frame mitigation, right, and 2, you have your 1 minute mitigation, and 3, you have your seconds mitigation. So essentially when I'm using the seconds, I have 3 different mitigations or 3 different confirmations telling me that look, price is actually going to follow through. So all this does is it gives me the confidence to say, look, we've got 3 different confirmations. This fits your plan, fits your rules. You've got extra confirmation. This trade will follow through. If it doesn't, then price is likely going to break that zone, or it's going to push up to an extreme zone and stuff like that. So this is how I use the seconds time frame, and I'm going to run through the Euro US dollar trade where I actually used the seconds time frame and give you an overview of what my thought process was for the exact trade. So as many of you may remember, I had a Euro US dollar trade here. We have a higher time frame zone mitigation over here, so let me mark that out so that you guys understand. We have this wick, right, this unmitigated wick, and we have clear inducement right below that zone, right? Didn't tap in, so we have inducement and we have our mitigation. So what happened was we had our mitigation here, so 1 minute, right? We had a 1 minute trade, a 1 minute confirmation entry here. So initially I had a trade here running. This was the decisional zone. Of course, this didn't follow through and it pushed up to the extreme zone. So this failed, and this was taken on the seconds as well. And I'll explain how this was taken. So if we look on the 15 seconds, sorry, it was the 5 seconds, most likely, yep. We had a first initial tap into the zone. We have a follow through, right? This is a decisional zone, so likely you should see price react to the last sell move before the push down. Sorry, last buy move before the push down. Now this range I marked was the last buy point that actually broke this demand zone and also confirmed a choke. So that was exactly why this trade was taken. Now, how did I take this trade? I marked the last sell candle, which is this huge candle, and I took a trade on the 25% mark of this zone. And in this point, you can see that we also have a lot of, it basically repeats itself. Whatever you see on the 1 minute, this is exactly what's happening on the seconds. Now let's look at the trade that actually followed through. Now, remember, we have an extreme zone over here, right? We have an extreme, we have a choke, we have a demand failing, and we are showing signs of bearish order flow. And we also have a bit of liquidity here. Now we've swept that and we've tapped into the extreme zone. What you could have done is put an entry here and put your stop loss right above this. So it could have been a 5 pip stop. Or you could have taken a trade on the equilibrium, maybe around here, and had your stop at about 3 pips, right? Still would have worked out. What I did was, as soon as I got my first initial mitigation, I dropped time frames to this point here, and I looked for what could be a good entry point. So essentially what we see is we have our choke here, we have a demand zone here, and we have something that failed, right? This demand zone got broken into, and before that demand zone got broken, what we see is sort of equals here and a liquidity grab. Now, why do I class this as a liquidity grab? A lot of you might be wondering, why is that a liquidity grab, Neef? It doesn't really look like equals. Now, the main reason why I class it as a liquidity grab is because when you see price sweep it, you see an immediate push down. When I mean immediate, you can look at how big this candle is, and it has pushed all the way down, breaking demand zones, creating a choke, creating a break of structure. We have all our entry requirements, and that is why I class it as a liquidity grab. So the idea behind this trade was we have the same thing. We have the exact same thing happening on the 1 minute that I showed you previously, happening on the seconds on this mitigation. Now on the 1 minute, the decisional, it mitigated but didn't follow through. So for me, in my head, what I was thinking was, cool, this is a decisional zone, the extreme zone is here, right? This region here. So price could tap into either this point or this point. So let me remove all those zones here so it's a bit clear. There we go. Right, so the thought process was that we have an extreme zone here, we have a decisional zone here. Now price could mitigate either one of them. So what am I going to do? Me being me, I'm going to take both of them because both of them make equal sense. This decisional makes a lot more sense for me because when you look at price, the main reason or the main candle that caused the break of structure or the choke or the demand zone to fail is this point here. And as you can see, it is an inside bar as well, just resting here. So that was enough confirmation and enough confluences for me to go, cool, I like this trade, I'm going to take it. So what I did was then set an order, right? And price essentially took a while. Let's fast forward it a bit, ranged a bit. And for me, I was still confident that price would come back. And what we saw was a immediate mitigation, and obviously price then melted all the way down, right? As we all know, price did hit our initial or our target take profit target, and it obviously went all the way down here, but our initial take profit target was just about here, and it went all the way down, right? We actually met it. So that's an example of how I use the seconds to take an entry of a valid 1 minute zone that has caused a chalk, a demand zone to fail, aka a flip, and every single thing in our entry requirements. So I hope this sort of clears everything out, because this isn't something that's secretive, something that the elite traders know, because all it is an additional layer of confirmation, and it can help you in a lot of scenarios. Now, before I end the video, I'd like to explain why and how this has helped me. Now, if we're looking at this zone, let's go back here, right? And I don't see, in this 1 minute mitigation, I just don't see a clear chalk, and I still see price going bullish. Then for me, I go, cool, price hasn't created a chalk to show that we are reacting off this 1 minute zone, and we're still creating demand zones and demand ranges telling me that price is still going bullish. That means that this zone is likely going to break. That's how I think about the seconds entry or the seconds confirmation entry when I'm looking for it. So by taking a seconds confirmation instead of placing a 1 minute order, it sort of gives me an additional confirmation that, okay, we actually do have some chalk, we have some, change in character, we have the order flow shifting, and all these different points that has actually saved quite a few losses of mine. And I don't want you guys to be enticed by me saying it saved a few losses, because the losses are part of your journey, right? Everyone takes losses, and the seconds time frame should only be something you look into once you're completely comfortable with the 1 minute time frame.